As far as the US economy is concerned, there has definitely been some slowing, so perhaps tariffs are seeping into prices. Tesla. Results were not good. UNH suffers from a series of problems. What's really intriguing is that both companies have agreed to pay 15% of their revenues from Chinese AI chip sales to the US government. It feels like the US government is selling an export license to Nvidia and AMD. This is quite radical and unprecedented, and it doesn't feel quite right to me. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. Before I get to the stats, now is a good time to reflect on the end of the quarterly reporting season. As I've said before, I'm not a trader. I don't trade stocks in and out of the quarter. I make my investments by studying macro and micro trends and creating investment stories that have long-term potential. I use quarterly reports and the current state of the US economy as a thesis check on my investments. This means I ask myself, do the macro and micro numbers align closely enough with my investment thesis to stay the course, or are they so far off the mark that my thesis is no longer valid? Here are some key things to always think about during earnings season. First, the micro. What numbers the companies actually report for the quarter and management's explanation and guidance for the quarter. That's the micro. Now here is how I look at the numbers companies report. Accounting rules are not ironclad. In general, it's easier for a company to manage its bottom line than it is to manage its revenue. Companies do have some leeway in when they book certain kinds of revenues and expenses. And that's why it's important to know what the expectations are for both quarterly revenue and earnings. And if management misses, that's a red flag that something could really be wrong. And it's why, especially with respect to growth stocks, that when a company misses revenue expectations, the stock can get rocked. Furthermore, conference calls are important because you can learn a lot by listening to what is said and not said, and the nuances of how the management spin their story. I always plan ahead on which numbers to pay closest attention to, and I pay more attention to the numbers and the flashy good news on the conference call. Many corporate managers are notorious for being spinmeisters. If what they are saying on the call is not supported by the numbers, ask questions. Also, generally, I personally find most earnings conference calls a bit of a waste of time. But because once in a while you actually learn something, you feel obligated to listen anyway. Just know that most of the time you won't learn all that much. However, once you've been on a bunch of calls, you get to know the management and can be sensitive to changes in tone. So once in a while, management might try to spin something positive, but you can hear in their voices that they don't really believe it. That does happen. Not that often, but it does happen. And here's a key point. Management sometimes lie. Yes, it's illegal, but they do it. I've seen managements lie right to my face, and it angers me every time. But I'll admit that sometimes it's not clear if they are lying or if they are just delusional, that they actually believe their own lies. I learned this from the financial crisis. Citigroup said all was fine, and then they cut the dividend. Lehman said the balance sheet was fine, and then Lehman was gone. That's why you have to do your own work. If all investors had to do was listen to management, investing would be really easy. And clearly it's not. During good times, listening to management is fine. They are only too happy to tell you the good news. Where things get dicey is when an industry starts experiencing a paradigm shift, like the financial crisis. During those tumultuous periods, the absolute last people you want to listen to are CEOs. They've grown up in that old paradigm, and they are often the last people to understand what's happening. Now, periods of paradigm shifts are unbelievably painful for both management and investors. The appeal of the good times often outweighs common sense, and when finally the problems are clear to everyone, there can be a lack of liquidity, so it's too late and you can't get out. We're going to come back to this in a bit. But now the stats. For the week ending August 15th, the S&P 500 was up over 1% and NASDAQ was up similarly. For the year, the S&P is now up over 10% and NASDAQ is up over 12%, and both are roughly at all-time highs. Quite a year. The week began with some pretty astonishing news with respect to semiconductor chips shipped to China. Like the Biden administration, the Trump administration has placed heavy restrictions on the types of chips that can be sold into China. And on Sunday, President Trump made an announcement that was quite extraordinary. Now, not all chips will be allowed to be sold into China, but Nvidia will sell its H2O AI accelerator, which is not its most advanced chip, and AMD will be allowed to sell its MI308. But that's not what's interesting. What's really intriguing is that both companies have agreed to pay 15% of their revenues from Chinese AI chip sales to the US government in order to secure export licenses. I don't believe I have ever heard of a company sharing revenue with the US government in order to secure export licenses. This is quite radical and unprecedented. It feels like the US government is selling an export license to Nvidia and AMD, something that has never occurred before. And it doesn't feel quite right to me. But more importantly, either China is our enemy or it is not. Either the US should sell AI chips to China or it should not. That is a very important policy decision. But now, the US government will be making money from the sale of chips to China, which leads me to ask, in the future, how will our government make the right decision on these important matters when it now has a vested economic interest in the matter? At the same time, China is making it pretty clear that they are not happy that NVIDIA AI chip sales will be restricted to just H2O and not the newer chips. There were some articles over the weekend in the Chinese press that the H2O chip has a backdoor that would allow NVIDIA to perhaps spy on the servers using the chip. Now, NVIDIA, of course, denied there is any backdoor, but that is not what matters. This is the way the Chinese government communicates displeasure about a foreign company. This happened to Apple in 2013, and Apple had to scramble to show China it was a good corporate citizen. Now, if you want to know more about this, listen to my interview with Patrick McGee about his new book, Apple in China. Also, President Trump extended the China negotiation deadline by another 90 days. In other news, the Consumer Price Inflation Index for July, the CPI, came in at 2.7%, which was flat with June. So no inflation yet from tariffs there. But 2 days later, on Thursday, the PPI, the Producer Price Index, jumped to 0.9% month over month, while economists were only expecting 0.2%. So perhaps tariffs are seeping into prices. We shall see. Earnings season is basically over. It always begins 2 weeks after the end of the quarter and usually lasts 4 weeks. There were only 6 companies in the S&P reporting this week. However, there is one big one to go, Nvidia, on August 27. To make everyone's life easier, it would be really nice if Nvidia would move its earnings to the normal 4 weeks, but I doubt that's going to happen. Now, I'm only going to discuss 2 companies that reported this week. First up, CIRCL. The new IPO is up over 400% from the recent IPO price. CIRCL is a company involved in the stablecoin space, and adjusted EBITDA came in at $126 million versus $121 million estimate. Revenue was up a very nice 53%. But the company has negative earnings, which is to be expected for a young company. CIRCL is part of the payment space, and to understand it, you really need to know the basics of the space and what CIRCL can and cannot conquer. So I'll be interviewing a guest who really knows payments, and we will drop that interview sometime in the fall. By the way, after the close on Tuesday, CIRCL announced it was selling 10 million shares, 2 million primary shares for the company, and 8 million from original investors who want to cash out. CISCO is the other company that I want to flag. I interviewed the head of investor relations of CISCO, Sam Badri, a few months ago. The company posted a decent quarter, beating both consensus earnings and revenue. CISCO, like Arista Network, its chief competitor, is another one of these tech companies that are benefiting from AI. However, over the years, CISCO has lost a lot of ground to Arista, and as a result, Arista is benefiting a lot more from AI than CISCO. That's why, when Arista reported its quarter, it beat numbers strongly, whereas CISCO only beat by a touch. CISCO is seeking to make up ground. I want to return to the importance of recognizing paradigm shifts. Paradigms are hard to recognize because when momentum is strong, investors and management alike are too invested emotionally and financially to read the tea leaves and to accept that the underlying investment thesis is breaking apart. Let me give you an example. Up until around 2016, the Master Limited Partnership Group, otherwise known as MLPs, was a great group to invest in. These were mostly oil and gas pipelines organized as Master Limited Partnerships. They paid big dividends, so retail investors loved them. These companies were run by traditional oil and gas guys, and they loved to build and build more and then build more pipelines because the MLP structure required them to pay out almost all cash flow as dividends. The companies retained very little capital. So, in order to fund their build out of more pipelines, they raised capital repeatedly, usually in secondary stock offerings. And over time, they also levered up. This worked until it didn't work. And here were the signs that the paradigm was shifting. First, rising leverage is a clear red flag that applies across most industries. This red flag was ignored as long as the MLPs kept paying those high dividends. Retail investors loved them and were only too happy to provide their beloved MLPs with more capital. Now, in 2015, I did a lot of work on the sector, and something bothered me. Specifically, I was uncomfortable with the leverage and the lack of capital retention. And I remember calling a sell-side analyst who I really liked, and I remember the conversation really well. I said to him, there are three big fundamental issues for this sector. First is, who has the best pipes geographically? Second, who has the most sustainable cash flow? And third, who has a strong balance sheet? I asked him to leave aside the question of the best pipes and focus on the numbers. Loving the pipes was easy. The hard part was whether the debt and dividend payouts were masking an underlying industry-wide problem. So I said to him, let's take out a clean sheet of paper, and you describe for me the metrics of a good balance sheet for this group and a strong dividend coverage ratio. And he gave me the metrics. I then asked him, how many stocks did he cover in this space? And he said something like 50 to 60. I then asked him, how many companies in your coverage fulfill those requirements that you just gave me? And he said only two. And that's when I knew there was a huge potential problem. Fast forward 6 to 12 months, and everything changed. In late 2015 and into 2016, oil and gas prices collapsed, and so did the positive sentiment for the space. At that point, because of the excess leverage and lower oil and gas prices, the dividends became suspect and the stocks started collapsing. Making matters worse, some public MLPs were majority owned by public general partners or GPs, and the GP first scraped 50% of its MLP's cash flow for itself. I remember I sat in a meeting with a major gas pipeline MLP that gave 50% of its cash flow to its parent before paying dividends to its own shareholders. And this management was so lost in its old paradigm, they were talking about raising equity capital to build more pipelines, just like the good old days. They couldn't help themselves. So I raised my hand and I said the following to them, quote, after the decline in your stock price, your dividend yield right now is 12%. But because you're also paying your parent 50% of your cash flow, your cost of capital is really something like 24%. I can't imagine any pipeline you could build that could produce returns equal to your now 24% cost of capital. Unquote. I remember that well. The CEO and CFO started mumbling answers that I swear were incoherent. They just could not see that their paradigm had been blown away. Coda. The industry went through a painful period of delevering and de-risking, but it did so kicking and screaming, and the retail investors were caught with devalued investments, shrinking dividends, and no liquidity. This is a clear lesson on why one needs to analyze a company's balance sheet just as much as an income statement, something we'll discuss more in the coming master classes. Just to finish the story, the industry went through a painful decline for a few years and only bottomed during COVID. And it has done well since then, but because of the big decline, the Alarian MLP index is only back to where the group was in 2015, just before the correction. Now I'll review my takeaways about the macro trends from the quarter and which earnings results I find the most intriguing. 1. As far as the U.S. economy is concerned, there has definitely been some slowing, but it's all due to the uncertainty surrounding tariffs. The underlying economy is still pretty strong, consumer credit quality is still benign, and so long as there is no trade war with China, I think the economy will be just fine. 2. With respect to tariff news, there was a lot of it almost daily. Europe caved to the president and accepted a 15% tariff. But I think that what is going on with respect to Canada and Mexico is the most intriguing. There is certainly a war of words going on between Canada and the US, but a lot of it is just theater, because President Trump signed a trade deal with Canada and Mexico during his first term, and he is honoring that deal. So all the goods involved in that first deal are exempt from any tariffs being discussed now. Now, President Trump has threatened Canada with 35% tariffs and Mexico with 30%. But when you remove the goods that are part of the first trade deal, the effective tariff rate on Canada is only around 3%, and Mexico is around 9%. But Mexico is trying to negotiate that down. So once again, there is appearance and there is reality. 3. The IPO market seems to have reopened with the IPO of Circle and then some of the companies that have followed. And M&A seems to be resurging. The big news here was that Union Pacific Railroad announced it was buying Norfolk Southern. A big merger like this that creates much more industry concentration would have been unimaginable during the Biden administration. I am convinced that the Trump administration gave the M&A advisors of these two railroads a wink and a nod that this deal is okay. And so I now expect M&A to really pick up. Who benefits? Well, clearly M&A advisors. In large cap land, that would be Goldman and Morgan Stanley. But the advisory pure plays are companies like Evercore and PJT Partners. Full disclosure, I own PJT Partners. Number 4, the results of the banks were pretty boring. The M&A news that I just discussed is far more important for companies like Goldman and Morgan Stanley. By the way, Jamie Dimon has gotten really critical of the budget deficit again. He does this every few years and uses his bully pulpit as the CEO of JP Morgan to complain about something. Now, generally, I don't pay much attention when he does this. For years, he complained about Fed Governor Daniel Tarullo, who was vice chair of financial supervision and essentially chief bank regulator of the U.S. Tarullo was too tough, he said. Tarullo was making banks deleverage too much, he complained. And he could not have been more wrong. Lesson? Just because a CEO is a very good one, and Jamie Dimon is a great CEO, does not mean that he is always right when he pontificates about policy. 5. The big tech companies generally reported good numbers, and their stocks keep powering higher. But despite a good quarter from Google, investors remain somewhat skeptical that AI is not going to hurt Google's search business. 6. Wireless and cable companies. When looking at this group, there are some very important lessons to be had. First of all, investors love stories. If you don't have a story of some kind, nobody cares. And these stocks are cheap. Verizon sells at 9 times PE, AT&T is at 13.5 times, Charter's PE is 7 times, Comcast is 7.4 times. These stocks have been derated viciously. Yes, they are optically cheap, but nobody cares because, again, there is no story. What story there is mostly bad. In the cable world, cord cutting is really hurting. And they are not just losing cable subscribers, they are also losing some broadband subscribers too. Unless something changes here, these are just value traps. In wireless, Verizon and AT&T are cheap stocks, but again, so what? They keep losing market share to T-Mobile. Only T-Mobile has a story, and that story is a very simple one. T-Mobile has the best and most efficient wireless network, and so it is able to pass those lower costs on to consumers. T-Mobile keeps taking share, and that's why its multiple is at least double AT&T and Verizon. Its PE is 23 times. Full disclosure, I own T-Mobile. 7. United Health. UNH is a good example of what I discussed before. When a company misses revenue and earnings, there is something seriously wrong. And then there is the cockroach theory. The cockroach theory says that when a company misses once, it's more likely than not it will miss again, because there is never just one roach. Truer words have never been said. UNH is a textbook case, And so is the entire health insurance sector. UNH reached a peak of over $600 per share in 2024 and has been cut by half. UNH suffers from a series of problems. Healthcare costs are climbing, and UNH's loss ratio climbs with it. And it cannot seem to catch up, at least not yet, by increasing pricing. Also, it is reportedly being investigated by the federal government about billing practices and the accuracy of claims submitted to Medicare and Medicaid. The company reported and gutted its guidance for 2024. But on Thursday night, interestingly, Berkshire Hathaway disclosed a new position in UNH, albeit a small position relative to the size of Berkshire's portfolio. I'm going to do a podcast on the health insurance sector with a particular emphasis on UNH. 8. Gartner, the tech consulting company. About a year ago, I heard a theory about software from Bob Reitzes of Milius Research. He argued then and argued now that AI reduces the cost of creating software to such a degree that the moats around some iconic software companies will erode. If you look at the charts of companies like Adobe, you can see that the market is worried. But it's more than just software. It's also consulting. That's why the results of Gartner were so interesting. Yes, Gartner's 2025 EPS will be down versus 2024, largely because the Trump administration is reducing consulting contracts. But there are also signs here that AI is impacting tech consulting. AI gives you info for free that companies would have hired Gartner to provide. And it looks like the entire consulting business is going to go through a period of retooling, and that could be painful. 9. Investors love stories, but sometimes stories can be too early. One big story in the industrial sector is that President Trump is trying to bring manufacturing back to the U.S. And as part of the budget bill, anyone building a factory in the United States can write the whole thing off from their taxes. But the tepid earnings results from Emerson, Rockwell, and Caterpillar show that that story is not yet here. Stay tuned. 10. Tesla. Results were not good. It is losing EV market share to China. The federal tax credits are going away. But the stock, while it's down around 11% this year, won't break. Why? Because there are potentially a lot of positives in the hopper, and I have an episode about this topic releasing late this month, so stay tuned. 11. AI is still the big story. But even within AI, there are great stories, there are good stories, and then there are not as good stories. So what do I mean by that? All other things being equal, it's always better to invest in a company that makes something proprietary than one that does not. Nvidia, Arista, Microsoft all sell products that are proprietary. These AI stories, I think, are the strongest. Now, some of the tangential stories like Supermicro and Dell have decent AI stories, but what they sell, mostly servers, are not proprietary. So their stories are not as good. And that's the wrap. I'm not going to do any mailbag this week because I'm saving your questions for the end of this month when I will be doing a podcast dedicated to answering your questions. This last Monday, we dropped a podcast where Melissa Lee of CNBC interviewed me. Our discussion was wide-ranging from my history as a sell-side analyst in the 1990s to the financial crisis to my current views of investing and the market. This Monday, I'm dropping a podcast where I interview Stephen Tusa of JP Morgan, the industrial analyst. Tusa developed a great reputation by being negative on GE for years, and we do talk about that. But we mostly focus on the growth in AI and data centers and how that is positively impacting many companies in his industrial coverage. Hope you tune in. If you haven't already, please consider subscribing to our YouTube channel, The Real Eisman Playbook, so you can receive these weekly wraps along with our podcast and the financial literacy masterclasses, which we will be releasing soon. Subscribing is the best way to help the channel, and we greatly appreciate your support. Finally, thank you for your comments and keep the questions coming. See you soon. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.